Have lower interest rates actually worked already? Did the Fed's impending rate cuts rescue the labor market just in the nick of time from a recession? According to the latest payroll report from the BLS for the month of September, it kind of seems that way. However, we should be careful about putting too much stock in, first of all, one monthly payroll report, but also in these kinds of situations. What we're seeing now isn't unusual at all. In fact, we always get in these cycles a slowdown. Everybody panics, everybody reacts to the negative data that starts to show up. And then, seemingly out of nowhere, things turn around. The data looks much better. Officials become more confident. They start talking about, do we even need rate cuts anymore? And then, again, seemingly out of nowhere, it all falls over. So what we're experiencing in the data is the usual fluctuations in the cycle, not just a month-to-month variation, but more than that, what is also normal. There's always a back and forth. Nothing ever goes in a straight line. We should expect that there are going to be months like this in the data. And the numbers that we got for the month of September 2024 were pretty striking, well above expectations in every respect. The payroll number comes in at 254,000, which was well above every expectation. Even the household survey rose by 430,000, which is the most since March. The unemployment rate fell to 4.1%, the lowest in several months. Even the underemployment rate retreated to 7.7%. But rather than getting too comfortable about the state of the economy, as I said, we have to realize this happens every single time. And every single time, a lot of people fall into the trap of thinking that this type of results means that everything is just fine and everything, or worse, they think that everything has been fixed by the mere appearance of central bank rate cuts. So, Steve, let me bring you in here, Mr. Van Meter. What was your take on the payroll report? I mean, yes, it was far and away better than expectations, but we've been talking about this all along. I wasn't surprised. You weren't surprised by these numbers at all.
No, in fact, Jeff, I think I messaged you earlier this week saying I wouldn't be surprised if we get a blowout number and beat all expectations. And
what you said, Steve, is we are going to get a blowout number. You said it's going to happen. Just wait.
Yeah, well, there you go. And what's great about this is it gives people all the confidence in the Fed, which is what the Fed really wants, is people to believe in them and believe in the mystique. Because all of a sudden you hear, wow, the Fed cut rates and look, the economy boomed and people hired. That's what they were waiting for, is the Fed to give them the confidence that rate cuts will change their lives. It happened. And now the fear, of course, Jeff, inflation may come back because wage gains were up. But as we talked about before the show, and this is really interesting, I want people to understand this. The Fed cut rates last month. This was last month's payroll report. So the question I'm going to ask you is, let's say the Fed didn't cut last month, or maybe the Fed raised rates 100 basis points. Would this report have changed?
Nothing would have changed. We know that. I mean, this is not about the rate cuts. I mean, we talk about this all the time. When the Fed hikes rates, they always say it takes, a long time for rate hikes to work. Are we supposed to believe that the mere appearance of an imminent Fed cut suddenly buoyed the market economy in some fashion? No, that's absolutely not what happened. I mean, you could make a case, you could argue, instead of the Fed rate cut being the reason, that lower market interest rates, and remember, treasury yields and market rates have been going lower for several months beforehand. You could say that lower market interest rates somehow stimulated the economy. So it's like you say, yeah. The fact that rates had anything to do with the September payroll report is a very tenuous connection. In fact, it's really just unrealistic to expect it to have any impact whatsoever. So we're left looking instead at what the numbers actually were and how it usually happens in past cycles, for example. Back in 2007, we saw the same exact thing take place. And I mean, almost down to exact dates and numbers. If you remember 2007, we had all sorts of trouble. Summertime, August, the global not financial crisis erupted. Payroll report was actually negative for the month of August, which was the estimate that was announced just before the Fed cut rates in September. It was actually a minus 4,000. So things look pretty grim heading into September 2007. The Fed cut by 50 basis points. And guess what happened in October? Suddenly, the payroll reports look really good. The October payroll report was plus 110,000. This is for the month of September 2007. So we went from minus 4,000 to plus 110,000. Plus the BLS revised August, which was minus 4,000, to plus 89,000. So it wasn't as bad as initially feared. The household survey came in at plus 463,000 for September of 2007, the same month that the Fed cut rates by 50 basis points. And lots of people then were saying either the Fed worked its magic or the economy was magically fine. And even the Fed thought, well, things don't look as bad as they did a couple months ago. So we're going to only cut by 25 basis points in October 2007. So they did a 50 and then followed up with a 25 because in large part, the data that looked so bad in the summertime started to look a lot better. And then there was one last thing. GDP came in the third quarter of 2007, the day before or the day of the Fed rate cut, the 25 basis point, at 3.9%. So the Fed said we got 3.9 in GDP. We got payrolls that were negative, but are now moving positive in the other direction. And by the way, the next payroll report for October, which came out in early November, was plus 166,000. So we went from minus 4 to 166,000. We got 3.9% GDP. And the Fed's like, we don't need to cut rates anymore. One more 25 and we're done.
Yeah, Jeff, and that's exactly what it looks like is going to happen this time. The Fed's going to come out and say, hey, look, we cut rates. They did exactly what we wanted. Policy slightly restrictive now, even though they don't really know where policy is, which I absolutely love. They just kind of guess where they think it might be, even though it does nothing. But still,
they have a dartboard that says neutral rate, and then they just toss things at it and see which one comes up. They have no idea what the neutral rate is, if there even is a single neutral rate.
Well, of course there's not a neutral rate. That's the brilliance of it, because if there was, you think a blind monkey at some point would find this thing, and they are smarter than that, and they just can't get it right. And so what this is setting up now is November. This could put them in a situation where they say, hey, we don't need to hike because the trend of payrolls is going to suggest that November is going to come out, well, good enough. And that's the issue here, is we know right after that's over, the odds of this thing starting to come unwound and the Fed playing chase, the probability in my book is going really high.
Yeah, and you'll be surprised, I know, Steve, that this actually happened in 2000, actually happened in 1990. Same exact thing. Like I say, this isn't just a one-off thing. Everything goes back and forth. Things look like they're getting worse. And then suddenly, just when you think it's going to fall off a cliff, it pulls back from the edge and things look a little bit better. We live in a very noisy, dynamic world, and so nothing ever goes in a straight line. That's true of the marketplace. That's true of Fed rate cut cycles. They don't go in a regular straight line either. They go from 50s to sometimes 25. Sometimes they'll pause for a couple of meetings. Then they'll come back with a series of 50s. It's all just an unpredictable crapshoot. And so we don't want to get too excited over a single pay report. Like I said, I mentioned 2000. Let's just quickly review that, what happened then. You had the employment report for December of 2000, which came out just the day after the Fed cut by 50 basis points, and it was 105,000. The household survey was plus 358,000. Then you go to the next month, the one right after the Fed cut rates. In fact, the Fed cut rates twice, 250 basis point cuts in January of 2001. And the January 2001 payroll went to plus 268,000. We went from 105 and things looking like they're pretty grim to 268. That Greenspan's a genius. A full percentage point rate cut obviously did the trick. And that wasn't the only one. The household survey jumped to 163,000 positive as well. And it just kept on going. So again, this idea that one single payroll report that comes during Fed rate cuts doesn't mean the rate cuts are working, nor does it mean that anything has actually changed. We should expect these types of monthly variations in all of the data series that we go over, because in the dynamic world, we don't have that type of clarity and certainty. Everything always fluctuates, everything from the marketplace to the Fed to the economic data.
But there's something that's been consistent in all this, Jeff, and that's the survey data. It's been consistently telling us from the factory and now the services that there are layoffs, that hours worked are getting cut. We're just not seeing that in the headline government data. And so it puts some confusion to people. Well, what's real? Are the people actually filling out the surveys who are hiring, firing people right? Is the government right? Where are all these jobs coming from? Because we're hearing these higher wage tech jobs, we're hearing manufacturing jobs, we're hearing all of those are slowly being lost. And what do we continue to hear in the reports? Demand is down, demand is down. And maybe the elections, maybe some rate cuts. And even then, Jeff, what's interesting to me is as I read these surveys, before it was, well, as soon as we get rate cuts, election, things are booming. Now there's changed their tune. We're hoping that the election and rate cuts do something. You can almost tell there's a shift now in the response rate because people are starting to wonder if it actually is something much bigger here. And then you get the payroll report, you go, wow, everything must be just so great. Stocks are up, spending is going to boom, but we don't see it all transmit through what consumers are actually doing.
Yeah, and I think that's why, economists have developed measures like the SOM rule to look past the monthly variation to try to look at where the momentum is. And even in the month of September, though the unemployment rate declined, the SOM rule was still right at 0.5, which is supposedly the recession confirmation, which means we've got 3 consecutive months of the SOM rule, which isn't really a rule, but 3 consecutive months of the SOM rule being in recession territory, even though the payroll report was really good, even though the household survey was positive, even though the unemployment rate fell for a single month. Like I said, it's not just a single month, and you have to look at all these other factors like Steve, you just did. And we were talking before, look within the payroll report itself. Where were these purported job gains? They weren't, as you said, the tech jobs. They weren't the high-paying manufacturing jobs. Those actually declined again. They weren't in retail. They weren't in wholesale. They were in leisure, hospitality, and government. Well, entry-level government jobs aren't too bad, but still, that's not the private economy. So you've got leisure and hospitality that's leading, along with healthcare, which is non-economic and non-cyclical to begin with. And the rest of it simply falls in line with everything else that we're seeing, despite the monthly fluctuation in the payroll report. We don't have the type of massive increase in manufacturing jobs that you would associate with companies ramping up production, anticipating an increase in the economy because rate cuts are going to be so successful. Or as you said, and we've been talking about all along, because the presidential election will finally be settled and we can get past it. Instead, manufacturers are cutting jobs, wholesalers, retailers, they're cutting jobs. And more than anything, we keep seeing the marketplace saying that this is whatever's happening in the data, which we should expect. It doesn't change the overall trajectory of where we continue to go.
No, it doesn't. And that's kind of why I'm at a bar today because, well, for the obvious reasons, but the question is, are these jobs here? Now, Jeff, I live in a place that is known for hospitality because it is the vacation destination of the world. And I know lots of people that work in the service industry. And you know what I'm not hearing from them is how things are booming. What I'm hearing, tips are down, foot traffic is down, restaurant, tickets are down. It's down across the board. Not one person is saying, hey, things are moving in a positive direction here where I'm getting optimistic. And people are getting very, very worried. But let's come back to the SOM rule because, I remember during the recent press conference that Fed Chair Powell was asked about the SOM rule. And he downplayed it as if it was nothing, which I got a huge kick out of because, well, you and I look at it and say, hey, this thing is relatively reasonably accurate here and does give us some reasonable trend of what could happen. And he said, that's not a rule. That's nothing. We don't look at that, which I thought was quite interesting here. But nevertheless, we look at the economy and something we talked about earlier was wage growth. And this gets people very, very excited. But one thing, at least from the headline news stories that they didn't talk about was hours worked. And this is what I'm seeing from my friends. Yeah, I've got my employer gave me a raise, my base hourly rate, and then they cut my hours. So we just don't have enough work for us to do. So they're cut my shift by an hour or two, and I'm out looking for a third job because maybe Jeff, you don't know this, but a lot of bartenders and waitresses and waiters, they have 3 jobs. They have 2 primary jobs and then the third to fill in job. And they're all telling me my hours are getting cut.
Yeah, that was the one part of the payroll report that kind of stuck out as okay, what about this over here? And that's one of the more important ones because the number of employees the confidence interval and the level of certainty over the payroll report is nowhere near as what people think it is. What they're basically saying is, we're not really sure how many jobs there were in September. It kind of looked pretty good in the data that we got. But if we run the simulations 100 times, we expected 90 of them that maybe we'll get the same number in, like I said, 90 of them. And it's actually in a pretty wide range. But then you look at hours. So whatever the number of employees that were added to the economy in September, like you're saying, what the BLS also said is that however many were added, the rest of them got their hours trimmed. The hourly index fell by 0.1 of a percentage point. It is basically flat for the last 4 months, going back to May, which is not a good sign. The average hourly work or the average work week fell to 34.2 hours, which is not a good sign because that's right back at the same cycle low. So whatever's going on in the number of employees, we're still getting the same types of indications that regardless of what the payroll report looks like at the headline, we still see this weakness underlying in various ways that suggest companies are struggling. They're still managing their cost structure, and the biggest cost continues to be labor and employees, which means that don't want to get too excited over a single payroll report, especially at this part of a cycle.
Yeah, Jeff, and I don't think people realize how important hours worked are, because let's say you have a small business and you've got, one owner and 3 employees. Well, let's say all of a sudden your fax machine goes whir and you get a bunch of new orders in and you get excited because, hey, things are turning around. The first thing you don't do is go out and hire somebody new. You turn to your existing 3 employees and say, hey, guess what? We got a bunch of work coming in. I'm going to increase your hours. And that's what shows up in the data. That's one of the first things we see if you want to know what causes the unemployment rate to go down. That's the first step. And then if the fax machine keeps whirring, then they'll say, hey, we need to hire someone because now my 3 workers are complaining about too much, too many hours. They're not seeing their family. That's not about the money. It's about time. And then they go out and then add employees. So the fact that we're not seeing hours worked moved higher here, in fact, as you mentioned, go flat for 4 months, is really not a good sign that we're going to see a change in direction, suggesting that this payroll report, maybe the next one, really aren't very valuable to us at all.
There's just too much variation, and that's true more this time around than any time we've seen before. There's always been revisions. There's always benchmark revisions that change the results down the road, and when people look back and get more complete data. But this time, I mean, we've been talking about this for how long now, and everybody knows, from the QCEW to the regular revisions, that the mainstream payroll reports are less reliable than they've ever been. So we expect variation. That's just part of what we go through here. And we also need to expect whether to get a handle on whether or not that variation is consistent with all of the underlying fundamentals that we would expect to see if there was any type of signal within that noise. Like you're saying, if hours are rising and the payroll reports are going up, and I don't just mean by a single month or two, but the hours are convincingly rising, then that would suggest that there is a material turnaround. We would see jobs growing in industries where jobs are not growing. Temp workers continue to decline. That's a big one. Because as you were saying, Steve, if you think that if the fax machine is really going off the hook here, then the first thing you could do if you've got all your employees working, you pick up the rotary phone and dial, and you can call a temp agency and they'll send over a temp. We don't see that happening either. So we've got temp workers falling. We've got the wrong industries hiring. It doesn't look like this is anything more than what we said previously, what you said earlier in the week. This is just another expected variation in the payroll report. But of course, it's going to be hyped everywhere. And because it's hyped everywhere, it's going to be tied to the Fed's rate cuts as if they are a magical fix on a short run basis to every single problem.